morning. Welcome to the XM.com weekly market update. And with me once again is the CEO of XM, Pete McGuire. Morning, Peter.
Good morning, Andrew.
I thought today we'd start with China. There's plenty of commentary coming out of China.
Understatement of the century.
Yeah, a lot of it is negative, unfortunately, for the Chinese, but we'll touch on a few of those figures now. The inflation rate, the chart there, this goes back 5 years. The last 3 quarters have been down. So,
well, that demonstrates deflation.
Certainly does. Considering, looking at the chart, how
Yes.
strong it's been for such a long period of time.
Yeah.
So there's a lot of talk out of China. Obviously, the equity market is struggling severely. The property market, we know.
Evergrande, we'll cover on that in a little while.
Well, Evergrande as well with the collapse there.
Yeah.
And the Chinese government has come out to say they're going to put some stimulus measures in place. What exactly they will be, who knows? The market hasn't really bought that yet.
No, 5th of February, I believe that's the blast off date, and I think that it's about 140 billion.
Yeah, and I think their playbook in many years gone by about ramping up infrastructure projects and property, they probably can't turn to that this time.
No, it's going to be a tough one.
Yeah. To give an idea of these equity markets as well, here's the CSI 300. So this is a 5-year chart. So that CSI, which is the combination of the Shanghai and Shenzhen, it's gone up to 2.6% in 5 years.
Yes.
And if we look at Hong Kong, which is...
well, just on that chart, if we can just go back there, I mean, I take your point, 2% in 5 years, but it did hit nearly 6,000 and it's nearly at 3,000. So it's wiped off the best part of 50% since the about August of 21. That is a monstrous sell-off. And if that's not that's a depression. Yeah. That's not a recession. That's 50% off the second largest economy in the world. That is frightening, Andrew.
Yeah, and one of those charts we brought up last week was that foreign direct investment into China had just fallen off a cliff. So now Hong Kong, this is horrible. So once again, a 5-year chart, it is down 43% in 5 years. Yeah. So, and to give you a bit of a comparison, the Nasdaq is up 110% in 5 years, and the S&P 500 is up roughly 90%.
Well, Hong Kong and China are cooked, and you talk to people, and they certainly, I don't know how they get growth back. Maybe we're just going through that deflationary time, and it'll hit a bottom, and there'll be buying opportunities. And is it 15,000? I mean, it's currently at 18,000. Is 15 where it hits a sort of correction? I don't know. Who knows? Catch a falling knife.
They're not good numbers. Over to the US, where the story is completely different. So a very strong economy. Are they heading for a soft landing? I think they've been talking about a hard and soft landing for over 12 months now. You could probably safely say they've had a soft landing. So it clearly hasn't been hard. No. And you wouldn't think there's any sign of a recession.
Well, no, but they are starting to lay off. There are big layoffs coming, and they've been fairly big layoffs, and that's going to be demonstrated tonight as far as non-farm payrolls. But I do take your point. You can't argue with, some of those stock numbers are just incredible. But certainly companies are trimming headcount dramatically.
Yeah. If we look at interest rates as well, this is a real interest rate chart, which is the interest rate less inflation.
Sure.
And that's those circled areas there. That's telling us the difference between the Fed fund rate and what that other rate is.
Yes, of course.
It's the tightest conditions they've had since the GFC. So
quite incredible.
That obviously will give the Fed, they're obviously not going to ease rates next month. No. And I suspect that is probably a few months away before they look to ease rates.
I wouldn't have thought it'd be April, and I don't think, and maybe it's going to be May or June. It could be a chance as far as a blast off.
Yeah, no, I think
it's a summer rate cut.
Yeah, the mid-year is, I think, probably fair, but they'll just look at those stats as they come out in the next couple of months to make a call on that. But yeah, it's interesting how that's they've certainly got room to move. There's no way around that. So, and once again, the GDP very strong again in the US.
Yep. Well, it's quite extraordinary, really. But that has to be one of the great points that underpins stock performance. You can't get the stock performance with a weak consumer, and weak consumers don't give you strong growth. So you've got, as the chart demonstrates, fairly strong GDP and quarter on quarter, and the equity markets have been showtime.
And you don't get strong equity prices without strong earnings.
Well, that's right.
You go back to the basics.
Yeah, you've got to sell your goods.
It all comes back to earnings.
And that's from the strength of the consumer.
Exactly. So, and we'll touch more on earnings next week out of the US, because obviously all the big tech companies have come out. Just one though, overnight, Facebook or Meta came out, huge numbers.
Unbelievable. Alphabet was down 7% and Facebook was up 14%.
Yeah, in the overnight market, or the aftermarket, sorry, Facebook, which is, like I said, a huge stock, up 14%, which is just extraordinary. So
1/7.
But wow, gold.
Yeah, you can see the attraction. I mean, from domestic demand as far as India and global, jewellery consumption, all the way through, running that back 5 years to the lows you saw there, 1230, about 1250, 1300, and it's just off the scale. We're at 2070 at the moment. 2073, you're only $70 or $60 short of the all-time high, I think. $70. So it might. Let's see what happens. But there's no shortage as far as tension at the moment everywhere in the world.
Yeah,
and
that seems to be building a little bit as well.
Yeah, it certainly does. Hope it's not conscription, because they came out in the UK, they were talking about conscription and they were talking about it here.
Yeah, I know, God, wow. No, we wouldn't want that. And finally, oil, it did recover a little bit sort of over the course of the last month, and it's just fallen away a bit only in the last week, but it seems to be still the US producing huge amounts, which is effectively putting a cap on that oil price for the time being.
Yep. And the Saudi Aramco, they came out and cut production by, instead of going to 13 million, they've cut it to 12 million. So the OPEC meeting would be just about over. It would be over in Vienna, and I don't think there were any real surprises there. So let's just see how the oil market trades. But the other day it was at 82, 83 in the last couple of days, nudging on 85, and there you are. It's flat out hitting 79 at the moment.
Yeah, and that's certainly helping the inflation rates around the world. So.
Yeah.
And actually on inflation, this week France, Italy, Germany, all the inflation numbers came out, and they're all sort of falling as well.
Yeah,
so
which is a good sign.
It seems to have maybe tamed the beast of inflation. But next week we'll touch on the Aussie market again. There's plenty going on there, and obviously a bit of a recap of some of those earnings as well, which has been some interesting stories.
I look forward to it.
All right, thanks again, Pete.
Look forward to seeing you.
Great. And that's the XM.com weekly market update.